Well, we got a big CPI print this morning. It was, shocker, higher than expected. You would think that the big banks and the wizards of smart, who are polled, I guess, who does the estimates? I think AP might aggregate it, or maybe it's Reuters. It's one of the two, I think. I think the consensus, so-called, was for 7.2%, and we hit 7.5%, or 7.48 to be more precise. But well above the estimate by a few tenths of a percent. Now, the headline across all the media, and actually I'm happy to say, I don't normally like to piggyback off of things that Tim Pool has said, but it just so happens he got to say it before I did today. I'm glad that someone with as big of a platform as he is kind of led with this. The biggest inflation in 40 years headline is not actually, it's understating how bad this situation is, because 40 years ago, we had a somewhat honest way of calculating inflation, at least much more honest than it is today. And if you compare apples to apples, and you look at Shadow Stats, which is a website that I have gone to for many, many years, it's very handy-dandy if you want to compare current inflation rates to past inflation rates. We're actually at 15.63%. It's more than double, using the old metrics, what the government says it is today. And so we're more than double where we were 40 years ago in 1982. It's, according to Shadow Stats, the highest inflation recorded since, I believe, 1947, in the aftermath of World War II, in which there was these huge surpluses in money, that is, because you had all these people coming home, and they had all this money that they couldn't spend because of the shortages during World War II and the price controls and the rationing. And so there was a massive spike in inflation, a massive surge in, it was essentially hot money after World War II. And we had a pretty high inflation there for a few years. But, well, actually, before I get to the president, the general consensus now by the wizards of smart is that they're interpreting this as essentially the sign that the Fed needs, the excuse that the Fed needs to be more hawkish on inflation than perhaps people would have expected yesterday. Because inflation is higher than expected, the Fed should be expected to be more hawkish than expected as well. But the inflation numbers alone, to me, are not what would signal or safely signal a more hawkish Fed. What I think is signaling a much more hawkish Fed is the fact that the White House appears to support the Fed actually fighting inflation, which is pretty rare. It's certainly not something that you've seen any president since Reagan really consent to. Every president is very pro-cutting rates and keeping rates low, because that's normally what's good for their image. No president since Reagan has ever tacitly endorsed the Fed hiking rates. The administration has either been indifferent and not really realized what was going on, didn't realize how negatively it would affect them, or they've opposed them, like in the case most recently of Donald Trump, who very publicly was mad at the Fed for hiking rates. But it's interesting, Joe Biden, I guess, like Ronald Reagan, recognizes that inflation is a big problem that has to be dealt with. And the Biden administration is now publicly signaling through Jen Psaki that they want the Fed to fight inflation. That's a part of the Fed's mandate, and that's their job. Inflation, don't blame us for inflation. That's the Fed's, job to deal with. And so that's as much of a go-ahead as Jerome Powell would ever need. I mean, that's encouragement. That's outright pushing the Fed to hike rates. And so because of that, people are anticipating, there's a whisper now on Wall Street, that perhaps we could get a rate cut prior to the March meeting, which would be very extreme by the standards of the Powell Fed. We've had so many years of ultra dovishness from the Fed, Honestly, I can't remember a time in which there was any sort of expectation that the Fed would, move quickly and ahead of schedule in a hawkish direction. In the short, in the time in my life, of course, I'm in my early 20s. But so that's not really saying a whole lot. But still, if you think about the people who are on Wall Street and actively trading, most folks get out of there by around 30. Either they've moved on because they're no good and they've moved on to another career, or they've retired. And it's a small percentage of the financial world that sticks around into their 30s, 40s, 50s, and 60s. And so, generally speaking, traders like me have never seen a Fed that, could be expected to act in such a way. And so some of you might be thinking to yourselves, oh, gee, that must mean that yields are exploding, right? Interest rates must be going through the roof if people are expecting that the Fed is going to hike rates, right? Wrong. We're actually seeing yields plunge. Why? Because they're already pricing in that as soon as the Fed starts to hike rates for reals, they're going to crash financial markets and the economy, but most importantly, they're going to crash financial markets, and that's going to lead to a instant flip-flop, a pivot. And so sure, because of this very extreme inflation, in the short term, the Fed's going to hike rates, but they're not going to hike rates enough to really kill inflation, because they're not going to be able to tolerate the pain. Right now, Joe Biden is telling Jerome Powell, okay, go ahead, crash the stock market, crash the economy, anything to stop the inflation. That's what they're saying right now. But when they finally have to take their medicine, boy, is that tune going to shift. Because I have to tell you, the people of power and influence in this country, I've said it over and over again, are far more impacted by asset price deflation than they are by consumer price inflation. Because these people aren't consumers, they are asset holders, primarily. They can tolerate consumer price inflation so far as they are incurring sufficient asset price appreciation. But even if the Fed is able to wallop inflation down to zero or even negative, which would be fantastic for consumers if the cost of living actually started to go down, since it has gone up so much. Just in my lifetime, I think about how much cheaper things used to be only a few years ago. And I'm not an old man. It would be great if we could get consumer price deflation. But even if that were to occur, if that was accompanied by asset price deflation, the rich would be getting poorer. And so there's no tolerance for that, because that's what really hurts the people who have influence. The people who work at the Fed, for example, the people in Congress, the people in the White House, the people who fund our politicians, the people who they talk to every day, the lobbyists. All of these folks are much more asset holders than they are consumers. And so I don't see the American elite falling on their swords for the sake of the little guy. Sure, right now, because inflation is such a big problem, it is so negatively impacting Biden's approval ratings. They're acting like they're willing to fight inflation. But that's because they haven't figured out how bad it's going to be for them. Once they realize that they're going to have to, feel some pain personally, they're going to throw us right back under the bus. And so some of you might be thinking, oh, well, I just sound like a sore loser because I've been saying that the Fed's going to be dovish and that they're not going to, they're not hiking rates and blah, blah, blah. Yes, you could just say, okay, well, I'm being stubborn. But it's more so, in my opinion, you can call it stubbornness. I could say, I really believe what I'm saying. I believed it then, I believe it now. The Fed is now, we've got over 7% inflation. If you think about it logically, in order to fight 7% inflation, you should raise interest rates at least to 8% so that you have a somewhat positive rate of interest. You have to have positive interest rates in order to incentivize people not to spend 100% of their paycheck and continue to push inflation. In order to get inflation down, you need to stimulate savings, not consumption. As long as you have negative real interest rates, as long as interest rates are below the rate of inflation, you are going to stimulate consumption, present consumption. I explained this, I think, rather well and in depth in my last video discussing inflation. But nobody's talking about the Fed raising interest rates to 8%. That's not going to happen. The Fed is way behind the ball. Even if they did a double rate hike, which used to be a single rate hike, 50 basis points, that's 0.5%. Okay, we would go from 0 to 0.5% rate of interest in this country, is 0.5% Fed funds. That ain't gonna cut it. That's not going to cure 7.5% inflation. That is unless the source of that additional consumption that is stimulating all this inflation is directly the result of asset price inflation. That's the one caveat. If that's the case, if all the inflation that we're seeing right now is a result of, let's say, crypto millionaires or something like that, or people who got rich quick in the stock market, or people who are retiring early because their stocks have doubled and tripled, and they have more money in their 401k than they feel like they could ever spend. If that's what's giving us 7.5% inflation, well, in that case, raising interest rates, let's say to 1%, and crashing asset markets, that actually would kill inflation. But you'd actually have to go through with it. You would have to bring back asset price valuations, to historic means. That would mean reducing stock prices by 75% maybe, at least 66%. I mean, you have to go way more than cutting stock prices in half. You cut the S&P in half right now. What's it at? 4,500. You get to what's that? 22,250. We were at 22,250 just a couple of years ago, and it was way overpriced then. Let's say you cut housing prices in half. Using my area as an example, since I'm familiar with my local real estate market and where prices have been, right now, $350,000 will buy you a shithole. So if you cut the price of that in half, what does that get you? Get you $175. So for almost $200,000, you'd be able to buy a shithole. That's still way overpriced. These are houses that probably, historically speaking, if we reverted to a historic mean, adjusted for inflation, the price of these homes that I see for $350,000 on the market now should be below $100,000, like $80,000. That would get us closer back down to where the historic average. Maybe when you adjust for, ordinary overall consumer price inflation, it'd be closer to 100,000. But my point is, if the source of our inflation pain is asset price overvaluation, the Fed can cure it with relatively few rate hikes, with not a ton of rate hikes, because this market is so fragile and has been dependent on the Fed for so many years, for so many hundreds of percent of increases. The market has multiplied many times based solely on Fed dovishness. That all goes away if the Fed turns net hawkish. I've explained this over and over. The more the stock market goes up, the more fragile it becomes. Because asset prices have gone to the moon since 2008, but the economy has just sort of petered along, barely going up at all. GDP growth is way below trend post-2008, yet asset price inflation, asset price growth is way above trend. The jaws must close at some point. And so that may just, cure our inflation problems yet. It won't bring consumer prices back to where they were. It's not going to reduce the standard of living, but it may stop the bleeding. It may bring inflation back down to normal levels, which to me should be zero. In fact, I think inflation should be negative, because if we are in a growing economy where we're learning to produce things more efficiently, the cost of living should go down. We should become wealthier as a society. Even if your income stays the same, innovation, technologically or otherwise, should reduce the cost of living. That's just the natural order of things. at worst, humanity should stagnate technologically and economically. Standard of living might plateau, but it should not go down year over year over year like it does, or like it has in the United States really since the 70s. So, an emergency rate hike, is it on the way? Perhaps. But this narrative is not going to last for very long. All of this talk of, as many as 7 Fed rate hikes this year, it's not going to happen. Listen, I would love for it to happen. If it happens, I will gladly say I was wrong. And I will applaud Jerome Powell and the Fed, begrudgingly, because I don't like them. But if they do the right thing, I will give them credit. But it's just not going to happen. They will soon regret what they're doing, and the yield curve reflects that. If the bond market really believed that the Fed was going to lower interest rates, the yield curve, or the yields would fall across the curve. They wouldn't just be following. They wouldn't. If they believed that the Fed was going to raise interest rates, yields would be rising across the curve, not just at the short end of the curve and falling at the long end. The reason why the yield curve inverts, well, there's a lot of reasons, but one way of interpreting the yield curve is that they're pricing in the Fed raising short-term interest rates and then lowering interest rates in the future as soon as they prick the bubble and trying, to stop the bleeding and to start pumping air into a new bubble. And so you end up with a situation to where in the short term, interest rates might rise, but long term they're going to be lower than that. There's other ways of interpreting an inverted yield curve. I've gone over that before, but I don't want to bore you with that. So with that said, I will see you folks back here tomorrow, and we'll see if the Fed comes out with an emergency rate hike. Yes, there are actually some people saying the Fed could announce an emergency rate hike tomorrow. That would be fun, but we'll just have to wait and see. So with that said, I'll see you then.